Hi, everybody. Welcome and thank you for joining us for Self-Directed IRA Saturday. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So before we get started, I got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest is going to play when it comes to your investing with your retirement accounts. We're really here to facilitate just about any type of transaction that you're looking to make and also act as a provider of as many resources and as much education as we possibly can. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investment. We're really here to be a neutral third party to just simply help facilitate the investments that you're looking to do when it comes to your retirement accounts. So for those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country with about 2.7 billion in assets under administration and over 100 employees, 34 of which are certified IRA service professionals. What does that mean though? Right? That means when you give us a call, not only you can have someone answer the phone and not have an answering machine, right? That'll be able to answer just about any sort of questions you'd be able to have. But if you wanted to take a deeper dive into the more nitty-gritty nuanced stuff, we have 34 IRA service professionals on staff to take that dive with you. And as it stands, we have roughly $400 million in undirected cash sitting in our clients' accounts. That represents opportunity, right? Whether you're a current part of that Quest clientele, right, or you're someone who needs funds to make your deal happen, that's where your opportunity is going to lie. But before you pursue any investment at all, the first step is always to educate yourself, right? Utilize us as a resource, guys. Check out our YouTube channel. Check out our website with our education center. We offer tons and tons of videos going over every aspect of alternative investing, right? We'll introduce you to the idea of self-direction and what it really is and what it really means. And then we'll eat all the way through making the syndication investments, right? Where you're dealing with things like UDFI and stuff like that. Right? We really cover just about every aspect of alternative asset investing when it comes to your retirement accounts. But once you've gotten educated on your investment, the deal's not just going to make itself happen, right? So that's where you need to start networking. So take advantage of our networking opportunities too. Keep joining the classes like you're doing right now. All right, check out our classes on Tuesdays. Check out our classes on Saturdays. And also come to our virtual networking happy hour on the fourth Wednesday of every month. That's going to be strictly dedicated to networking to allow you to meet other Quest clients and some people who aren't even Quest clients, right? That have different perspectives and different opportunities that they can present to you. By far, our most common social is going to be the SDIRA social on the first, second, and third Tuesday of every month, starting at 6:30. That's going to be in Houston, Austin, and Dallas, respectively. Now, the reason these are so popular is because we allow for 30 minutes of networking where you get to meet everybody in the area. And we allow for someone to come out and speak for about an hour, about 45 minutes to an hour over any given topic, right? It's going to be different every time. But after that, we allow for more networking and deal pitching. So if you have an opportunity, right, and you need some capital or you have funds that you're looking to lend out, check out the social that's going to be in your area. That way you can present your opportunity to the other Quest clients in your area. But coming up, we have our Masters of Tax Avoidance Bootcamp. Please check this out, guys. This is going to be $150, and what we're going to go over is how people can make the most of these tax advantaged accounts. All right, we're going to have a specific focus on oil and gas sector. So if you have questions at all, reach out to an IRA specialist. You can reach out to myself or Andrea. Andrea will be in the chat. Give us a call, ask us some questions, see if it's something that you'd want to attend. And if it is, we can even offer you a little bit of a discount. So I'm really excited about this class today, right? So the reason is because right now we're dealing with a market that a lot of people haven't experienced, right? If you just started your investing, right, whether it's in real estate or in the public market, if you started after 2008, you've had a pretty good experience up until this point, right? It's as long as you played it safe, you didn't do anything crazy, you're pretty much able to get a return on your investment. But now that the market has taken a bit of a turn, right? Real estate is a little volatile. Well, we're seeing people scrambling. We're seeing people trying to figure out what they're going to do to navigate this type of market. And that's why I'm excited for Ryan Gibson to come up and talk about the opportunities that self-storage can present to you, because a lot of people see it as resistant to the market, right? Whether it be real estate or the public market. So without further ado, Ryan, you there?
Hey, Zach, thanks for having me on today.
Absolutely. Well, I'll give you the floor.
All right, thank you so much. Thanks for having me, and appreciate everybody at Quest, and hope you're having a great Saturday. Today, we're going to talk about self storage investing in 2023, and I'm going to start with just kind of talking about what we're seeing in the market, what we're buying this year, sort of the trends that we're looking at, some of the things about self storage values that have not come down at all, and I'll kind of get into the reasons why. And kind of go into a strategy of how we acquire and buy facilities. But then we'll conclude with an actual case study of a real self storage that we bought in Fort Worth, Texas, a couple of years ago, and have turned around and refinanced all the capital out of it. So, without further ado, I'm going to go ahead and just start with talking about where we are today and kind of what we're looking forward to next year. So, kind of looking at the interest rate forecast for 2023 and beyond, you can kind of see here this gold rectangle that I have on the screen. That's where interest rates are predicted to go in 2023. And I think it's super important to kind of understand where we are in the cycle. So this is just the 1 month SOFR forward curve. And that basically just means if this is a prediction of where interest rates are thinking they're going to go, the experts are saying they're going to go. And you can go to the Chatham Financial website and you can pull up this information at all times. It's constantly changing. And you can see that the Fed is going to meet a couple more times and raise interest rates. That's what they're saying. Right now we're about 4.4% or so, and they're going to increase this to as much as 4.9%. So it's going to get worse on interest rates, I think, before it gets better. And when the Fed has their meeting coming up within the next week, we're expecting to see about a 1/4 point increase. So if you're thinking interest rates are coming down from the SOFR or from the prime side or from lending on commercial assets, you're probably in for a couple more rate hikes according to this forecast. But what's really, really interesting is that over the next year or two, rates are supposed to bottom out again in late 2024, early 2025. So if you're thinking about putting debt on a property right now, it might not be the best time to do it. But if you can buy something in cash, you probably are going to be in for a really nice opportunity coming up here in 2024, 2025. And this information is publicly available. So everybody kind of sees this trend or this forward curve coming where interest rates are going to go back down. Now, again, I don't have a crystal ball and I'm not making giving any advice or anything here, but this is what the experts are saying, and this is what we can kind of expect going forward. Interest rates are going to go down, so what you buy today might not get the leverage on it that it'll have in the future. Now, that being said, the people who predict this information, they're like weathermen, right? Their forecast is always right unless they're wrong. And there's no consequences necessarily for their predictions. So, I think what's really funny is if you think about in 2022, this time last year, in 2022, we were sitting at the federal funds rate of 0.008%. And what the Fed funds rate is just a fancy way of saying the overnight borrowing cost banks have to lend. So the banks had a very low cost of capital a year ago. And we looked at the forward curve last year at this time, and they said worst case scenario, 1.5% is where the federal funds rate was going to go. And if anybody on the call can guess where the actual rates ended up presently today, 4.33%. So way, way, way worse than any predictions that any smart economist or financial analyst put forward. They were way off. Everybody was way off. So when you look at, kind of how 2022 was projected, it got way worse than what they thought. So, and if in the slide prior, I showed, rates coming down. What will it do? I don't know. The crystal ball factory is broken, unfortunately. But I do find that something I was looking up, it's called the Harry chart, and Chatham Financial puts this out as well. And the way to read this is, you can kind of look at this chart and you can see the hard blue line. The hard blue line is where rates have gone over the last 20, 25 years. And the little hairs that come off of that was what people were predicting the interest rates to go to. So let's look back just in the last 20 years, from 2020, from 2000 to about 2020. You look at that chart, it shows that interest rates were predicted to be far, far worse than what they actually were. So if you look at those little, right where that arrow is at the bottom there, you can see that they predicted interest rates to really climb from 2010 to 2020, and they didn't. They stayed flat. They stayed much, much lower than anticipated. The other thing that I want to kind of point out is look at how high rates were in the beginning there, and then they really kind of went down in 2010 through 2020. It puts into perspective all the way on the right where we are with interest rates today. We're really nowhere near kind of the worst case scenario. Rates are still very historically low. They feel high because they're so much higher than they were a year ago, but really they're kind of still in line, below kind of a worst case over the last 20 years. But what's interesting is they got 2022 wrong for the first time, I feel like, in 20 years. And again, there's little nuances here, but if you look at where rates went much, much higher. And if you look right where that arrow is pointing, the predictability that it'd go up to 1.5%, and then they actually going up closer to 4%. The crystal ball factory, again, broken in 2022, a lot of aggressive rate hikes despite what the forecast was. So anybody's guess what the interest rates are going to do this year. Still historically low, but we're in a good spot, and I think this is how we're going to win in 2023. I think, and really what we're planning to do at Spartan Investment Group. Consider buying things all cash. We're starting 3 funds this year. We're going to buy facilities. A lot of these facilities all cash. We're actually planning on closing a facility at the end of February, early March. We're paying all cash. We've gone onto the market. We've seen interest rates being quoted in the low 6s to low 8s for traditional banks. And I know they're kind of all over the place, but it really depends on your leverage and your DSCR and things like that. But we see rates really, really high. And when you look at buying a facility that has strong fundamentals, it just doesn't make sense to put interest rates or bank debt on that property today. So we're thinking about buying all cash, and we're thinking about refinancing strategically. The next thing is buy assets with NOI growth and fundamentals, meaning that buy assets that are below market value in rents, buy assets that you have a strong population growth, strong fundamentals in the economics that surround that investment, something that's going to mature and do really well over a period of time. And if you're going to buy something with debt right now, make sure you have flexible refinance terms. A lot of lenders right now are baking in things like no prepayment penalty, or if you refinance with us, it'll be at a reduced rate, or some kind of promotion that has to do with knowing that the interest rates are going down. Everybody knows they're going down. So at some point, you're going to want to refinance, and they want to keep your business. So it only makes sense to align with your bank if you're going to use debt right now. So, and if you are buying all cash, this is really important. Do your due diligence like a lender would. The risk in buying all cash is you don't have that bank backstop, right? That's going to ask you for all the paperwork and ask you for all the documents and ask you for all the studies and things like that. So when you're buying properties right now, take it through its paces like a lender was standing over your shoulder watching every single thing you do, because in the future, when you decide to refinance it, you're going to need that. And then be opportunistic on purchases. Obviously, there might be some opportunities in this market where somebody had short-term debt or floating interest rates, and now they have to sell. So be opportunistic on what you can buy. Beef up your acquisitions team, look harder for deals, and I think the opportunity to buy is still a great time. It's a great time to partner on resources. You might not have all the cash you need. You might not be able to take down a facility on your own. Now is a great time to maybe JV or syndicate or do something that you can take down a really good opportunity with. And then I would focus on assets that have favorable tenant landlord laws. Obviously, self-storage is very good for that. Industrial, warehouse, etc. Is very good for that. I've seen a lot of legislation lately that is being proposed in the state of Washington and in Washington, D.C. that is really making it difficult to be a landlord in residential. And so just be mindful of that going. It's going to get worse probably before it gets better. So if you've never seen a presentation on storage, I always like to do some framing of the industry and kind of give you a little bit of background. So there's more self-storage in the United States than all fast food chains combined. If you combine all the McDonald's, Burger King, Starbucks, there is 60,000 self-storage facilities in the United States. And if you combine even throw in Dunkin' Donuts and Pizza Hut and a few others, there's still more self-storage. I always like to look around when I go to small towns, and you'll notice one or two or maybe three facilities, even in a small town, and you'll have a difficult time finding maybe that one McDonald's or that one fast food place. So it's everywhere. It's here to stay. It's not going anywhere. And in fact, 1 in every 10 American uses a self-storage. And we found that our customers, 66% of them have a garage. And so what that means is 330 million Americans live in the United States, and that's 33 million people that use self-storage. So the industry has a ton of scale. And at 60,000 facilities in the United States, you can break that down into about 550 customers per property that pay us reoccurring revenue, tenant insurance fees, and all the rest that make up this really great asset class space. And what's great is these tenants don't require you to don't require flushing a toilet. They don't require intensive customer service. They don't need appliances in their units. They don't need water heaters. Our tenant landlord laws are incredibly favorable. There's no evictions in self-storage, so you can do the auction process, which is kind of like an eviction. But really, the lease tells you that in the first 30 days, if you don't pay your rent, or if you don't pay your rent within 30 days, we can lien your belongings and auction them off. So there's really no, detailed or going to court or things like that for an eviction process. It's very, very favorable to the operator. And lastly, we don't have units that look like that, where the units are trashed. I mean, the worst case scenario, they might have broken a lock or something, but this is 4 metal walls and a concrete floor. There's not a lot of maintenance. But I think probably the best part about self-storage is that it's based on life events. No matter who you are, rich or poor, old or young, moving or not moving, changing jobs, whatever it might be, life events are why people move into self-storage. So I know everybody knows that Americans have a lot of stuff, but the reality is we have a lot of stuff, but we also have a lot of life events. And when you look at COVID and recessions and things like that, that's why you see self-storage being really recession resistant, because during those times, life events are happening. When I was, I currently or previously worked as an airline pilot, and I remember flying a 737 down to Florida, had about 185 seats on it, and right when COVID hit, I was flying this jet down to Florida, and I'm looking in the back of the airplane. There's one passenger, and I always remember this story, and I went up to this lady and I said, "Hey, I got to ask you, you get your own private 737 to go to Florida today. Why are you going down there? Nobody's flying right now. It's COVID." And she said, "Well, my mother unfortunately just passed away. I'm going down there to put her stuff into self-storage." So self-storage happens regardless of what's going on in the economy. Obviously, when COVID hit, we had this huge life event for the entire country, for the entire world, and everybody hit the road. They packed up their stuff in RVs. They had to take their rooms in their houses and turn them into gyms. I mean, the Peloton boom, or people had to work from home, and they had to free up that space in their house to put in their office or make their podcast studio or whatever it might be. So self-storage really boomed during some of the worst times. And so as the economy turns over and things like that, people have life events. So looking back over the last 4 declines in GDP, the gold bar is self-storage occupancy, the blue bar is GDP and its decline. And you can see that, starting from Black Monday of 1987, when the markets created over 30%, self-storage occupancy did really well. You look at the dot-com bust of 2000, when the markets tanked, you can see self-storage occupancy remained incredibly strong. And then the Great Recession, when everybody got hit really hard, self-storage occupancy was consistently performing way above where GDP was. And then if you look at the last decade, from 2010 to 2020, you can see slowly self-storage occupancy, or very rapidly, depending on how you look at it, increased about 10% average occupancy as an industry, while GDP cratered during the onset of COVID-19. And during COVID, rent growth nationwide was 12.7%, double-digit rent growth. And we've seen double-digit rent growth in 2020, 2021, and in 2022, with rents, some of the worst performing REITs actually performing at about 14% NOI growth, same store growth year over year in 2021. at still double digits at 14%. So we've seen a really good performance during downturns, and especially during the COVID-19 pandemic. So if you look at kind of how the REITs performed, you can see when the onset of the COVID-19 pandemic set in, the gold bars tell you how bad that REIT was hit, right? And you can see self-storage was hit very slightly, but then outperformed all other REITs during the COVID-19 pandemic. So really, really excited about that. Now, a lot of people say, well, Ryan, I'm in Florida, or I'm in New Jersey, or wherever I am, and I just see these things popping up everywhere. How could we possibly keep building and building and building all these facilities? Are they filling up? Is this working? Are they profitable? And the answer is it depends, but largely as an industry, it has done really well. So if you look at from 2010 to 2020, if you look at that gold bar is showing you that occupancy is increasing, right? So you can see that 10% average occupancy growth from 2010 to 2020. Now, what's really interesting about that is there was more self-storage built in that 10-year time frame than there had been in its 40-year history. So that means that despite all this inventory coming online, all these facilities being built in your hometown, average occupancy not only was consumed, not only do these properties fill up, but as an industry, they're more full than they've ever been. So it really goes to show the growth that we've had in self-storage. And I kind of, life events is the big one, right? But I kind of attest this to convenience. Everybody knows in their market now, or in their hometown, they're going to have a self-storage. So they know they have this as a tool to use. 30% of the customers that use our properties also are business owners, people that use furniture equipment staging, for residential or for commercial, or when the offices got downsized, or Little League baseball teams, sheet metal contractors. All these things line up to self-storage as being a very good convenience for people. So it's really not going away. Again, during the COVID-19 pandemic, self-storage did really well. We had no eviction moratoriums, no restrictions on the government. Doesn't matter if you're in a blue state like California or a red state like Texas. We did not have any government restrictions on self-storage. We could raise our rents. We could still evict. We could still kick people out. And I always like to chalk this up to people. No one cares about grandma's dresser, right? The government was all about protecting people's dwelling, people's home, the people they don't want to get kicked out of their house, but storage units stayed off the radar. And it was no wonder that during the pandemic, from 2020 to 2021, the REITs went on a buying spree, specifically Public Storage acquiring $3.3 billion of storage. Blackstone got into it with the acquisition of Simply Self Storage as their operating company for $1.2 billion. Bill Gates invested in self-storage in 2020. Inland Private Capital Group monetized a big portfolio. Simply went on another buying spree and bought a huge portfolio in the Houston and Dallas area. CubeSmart bought a big portfolio, and then obviously the Wall Street Journal started picking up on it as the pandemic's hottest property. And then our company, we bought about $270 million actually in 2021 and really acquired a lot of assets. So where is it today? So all this stuff happened in COVID. Okay, so what? What's happening now? Where are we in the 2023 market? Well, this article just came out literally yesterday, and one of the largest self-storage funds ever to be closed just yesterday, $2.5 billion from one group that's going to go on a buying spree and pick up self-storage, despite all the headwinds that we're facing today. And it's because the data is holding up. In 2022, we see an average household utilization of self-storage increasing to over 11%. So when you start looking at the total households that are consuming self-storage and its average rate of consumption, it's only increasing. People always say, millennials, they don't like their stuff, they move around and they like experiences. That's all true, but the reality is that they're still using self-storage. And Gen X is still using self-storage, and baby boomers. And Gen Z is now starting to enter the equation and use self-storage. And so when you look at that customer demographic, this shows you the entire U.S. population, and the percentage of the generations that are using self-storage. And you can see millennials, the largest generation right now, the biggest population that we have in this country, they're the largest customers of self-storage. 34% of our customers as an asset class are millennials. So if you're thinking that millennials, oh, they're not going to use self-storage, they're the ones having life events, right? They're the ones growing their families, changing jobs, moving around the country, et cetera. So we see this massive movement of millennials using self-storage, and they're our biggest customer base currently. So where do we invest? Spartan Investment Group, we look across the country. We're really kind of agnostic to any specific market, but we've narrowed down our buying criteria to the 150 best markets that we consider for self-storage. This is anywhere from, growing population, growing income, where the jobs are moving, where the solid rental rates are, and that's pretty much landed us in Texas, heavily focused around the DFW. We even have one north of Houston, and in the East Texas region, Tyler and Longview. That's one of our we're one of the bigger operators there. And then we look at the Sun Belt states, or the Sunshine States, whatever you want to call it, Florida, Georgia, Tennessee, and then we look at we're headquartered in the Rockies, so we have a little presence there, and then up in the Pacific Northwest. So you can see really, kind of a smattering of properties, and we like to cluster them together to get really good efficiencies and economies of scale in our portfolio. And this is netted, so we have about 60 facilities or so, or about 30,000 units across the U.S. So what do you need to do in 2023 when I talked about doing lender due diligence, right? What do you have to do to make sure that, if you really need to make sure you do your due diligence on the property? Well, we have a thorough 700-point due diligence checklist. And if you wanted to download this, you can actually go right to our website and you can download it, right on our main page, right below the values grid. It shows you right where you can download this. And these are all the things that we typically do. And we break this down into, I think it's 700 or 800 lines now. All the little things that you have to do based on the type of property you're buying. So, due diligence might be a little bit shorter if it's an existing property, might be a little bit longer if you're building one from the ground up. But generally, these are the types of things that we put the property through to get its paces down. What's our exit strategy? We like to think of ourselves as kind of like a medium-sized fish. So if you're looking at getting into self-storage and you're not holding forever, you might want to consider what your exit strategy is. And I never like to have, especially in self-storage, one particular asset class exit strategy. So, but our buying strategy is we buy mom and pops. We buy facilities that are mom and pop owned. Maybe they're not running them efficiently. Maybe they don't have revenue management or a call center or good marketing. And we come in and we buy those facilities and we kind of build up a portfolio. We kind of aggregate these properties. And then someday we hope to be maybe swallowed up by a bigger fish. Well, who are the bigger fish? Well, we're the 40th largest operator in the United States. There's 39 much larger companies ahead of us that are hungry for this type of storage. That fund that I mentioned that just put together $2.5 billion, they're one of those buyers. So there's a ton of groups that are looking for big portfolios that they want to take a bite of, and Spartan is kind of an aggregator as such. And today, at the end of this, I'm going to show you an example of a mom and pop facility that we found and how we kind of fix it up and turn it around. But one of the things that, really storage benefits from is great location. You want to make sure in 2023 and beyond that you're buying a property that's in a great location. You want high traffic count, 10,000 plus cars per day driving by the property. You want to have good street frontage. You don't want to have some facility that's way in the back that nobody can see. You get a lot of your customers from drive-by and walk-in. And most of your customers are going to live right around the property, right? So they're not going to drive 4 hours to your storage facility because it's in a better market. They're going to look for price and location. So location's a really big deal in self-storage. And if you can find, like we have, you can see the red clusters. If you can kind of co-locate a bunch of smaller properties or even medium-sized or large properties in an area, you can start getting economies of scale, which means that you can save on marketing dollars, or you can save on employee cost. You can highly automate, and you can take out the day-to-day store manager from being there all the time. So there's really a lot of benefits that you can get from having a cluster or a bigger portfolio. especially on the operation side, but then also on the disposition side. Because if you go to sell these properties, a big publicly traded REIT is not going to buy one property in the middle of nowhere or one property in a market that they're really not in yet. They like to know that, if they go into this market, that you've got 10 or 11 properties there, they can make the acquisition and then they can be efficient in the way that they run it as well. So economies of scale is really important. Obviously, this is going to help increase your revenue, and overall, this is going to help with better returns if you're considering getting into this space. So before I go into the case study, I know that I've spoken at the Quest meetups before, and the previous case study that I had was a property in Corsicana, Texas, which is about an hour south of Dallas or so. And this property is like our bread and butter. So I wanted just to kind of show a video of it. This property came with 735 units. It was full. It had about 81,000 square feet. And it had both these interior climate controlled units, and it also had the exterior units. But sometimes these properties come with weird things like car washes on the front, which we spun off and sold. And they also come with other ancillary revenue services like U-Hauls. You can charge for U-Hauls, you can collect revenue that way. But what we really liked about this property was the fact that it came with this vacant land for expansion. And so we put these two buildings on there and increased our unit count by 240 units. And so our construction company comes out there, we do all the permitting, grading, we build the additional units, and then once those units are all completed, we lease them up. So we do things like market to our customers, put in a call center. We do things like get involved in the local community, like we do like ribbon cutting ceremonies with the Chamber of Commerce, things like that kind of help promote our property to the general public and then get it leased up. So that's kind of our bread and butter. You can see here we got some outdoor units. There's also some indoor units. So we do both the temperature climate controlled units, which in Texas get a little bit better of a premium, and then we do the outdoor units as well. So let's talk about the new case study. This is a property that we bought in late 2019, Fort Worth, Texas, and it was garbage. There was a lot of garbage, actually. The facility was owned by one individual who just got too busy and just let the property go. And these properties are still all around the country. There's still opportunities like these that we see every time. That's one of the units that represents like most of the units where people had just abandoned their stuff. They had stopped paying. People weren't on leases. People didn't have locks. There was black widow spiders kind of all over the place. Some of the units had just gravel in them. Some of them were paved. It was funny when the property inspector came out to the property. He couldn't find the property because he just assumed he put it in Google and find it, but the guy wasn't even the previous owner wasn't even listed on Google. He didn't even have a working phone number, so when he tried to call the facility to figure out where it was, the number didn't even work, and nobody answered the phone, and nobody took on reservations. So this was kind of like your classic rundown property. This was my favorite one. There was actually a tree growing inside one of the units that had made its way through the metal wall and was kind of growing inside and outside of the unit. So don't worry, we ended up removing the tree. And this was the sign. Really a really attractive sign that I'm sure garnered a lot of customers. So our basic business plan and something like this, and this is something that you can do as well, is, we were going to buy this property, and we negotiated a $1.335 million purchase price. And you might be thinking, wow, you paid $1.3 million for basically this abandoned property. Well, the reality is that it had about 60,000 square feet of metal buildings, or about 209 units. And while it was 14.5% full, if you do the math here, 1.335 million divided by 60,000, we paid $22 a square foot for this property, which is an incredible price because today you couldn't build buildings for $22 a square foot. This property replacement value is somewhere between $70 and $90 a square foot, depending on where you are. So really, it would cost you a lot of money, a lot more, almost triple what you would pay to buy this property. So a really good deal. But what's interesting is, you buy this property, it was actually losing money. So even if we paid all cash for it, not even have a loan on it, we were negative $21,000 a year in the hole, and it needed $300,000 to fix it up. And while we held the property, we needed another $40,000 because we need to cover our losses, right? So we're fixing it up. We're running negative NOI. So we needed time to get the place fixed up and kind of pay hold cost. Even though we paid all cash for it, we still needed to pay property taxes and maintenance and insurance and all the things that you have to pay regardless if you have a note or not. But we saw the opportunity. The opportunity was if we got these units leased up to 90% and we got market rents based on our demand study of like-kind property, we could actually get NOI to $288,000 a year. So we could go from negative 21 to $288,000 a year, which is incredible. And if you do the math, that's a 16.5% cap rate on cost. So here's how you do the math. Well, you have to take all the costs surrounding the property, so that $1.335 million of purchase price. You add the $300,000 fix-up costs, $40K of lease-up losses, $25,000 of closing costs, and about $50,000 just for reserves. So $1.75 million was our total cost, right? That's when I say cap rate on cost. Then you divide that by NOI of $288,000. That's a 16.5% cap rate. Now, you probably got to put a lot of elbow grease on it, but this is a way to buy a 16.5% cap rate deal potential. Now, we are preparing the sale somewhere around $4.7 million. And we expect to make about a $3 million profit plus all of the distributions income that we earned along the way. I didn't bother calculating that for today, but I think it'll be around $500,000 or so dollars in additional earned income. So what's the mission here? It's to climb up this big mountain, right? It's to fix up this rundown property that's 14% occupied and basically get this business functioning again. So first thing we had to do is we had to get 25 dumpsters to the property, full 40-yard dumpsters, and we cleared out all the trash. We had to clean up all the leases. We had to make sure we had permission to throw everything away, that the units were really vacant. So a lot of cleanup to do, a lot of cleanup work. Then we painted the buildings. We put concrete in the units that didn't have concrete floors. Customers tended to like that a lot better. We had to fix the gate. It was interesting. The gate was actually too close to the road. So a lot of boat and RVs were stored in this facility, but you couldn't turn off Boat Club Road without your trailer hanging out in the busy traffic. So what we did was we made it more convenient on the customer and moved the gate further into the drive aisle so that you could completely pull off the road and not get into an accident when you pulled in. We had to change out a lot of locking mechanisms. And then we also offered a nice amenity, free air, a lot of boats, traffic and trailers. And then we implemented our call center and revenue management software. This makes it easier to book. It makes it easier to track revenue. It makes it easier to issue invoicing and collect customer income. And then lastly, or the next thing was marketing and branding. We had to market and brand the facility as a well-run, well-staffed, good, secure facility that you could move into and that was fully operational. A lot of trust was broken with the previous customers because this place was basically kind of left, kind of let go of the controls and just let it nosedive. So you had to build back that trust by having a good employee at the site, somebody who could take ownership of it and really kind of help market and brand the facility as being a safe and secure place to live. And then we added additional units. So you can see, if you look at an aerial of the site, you can see there's a lot of excess land. We added additional parking spots for boat and RV storage outside of the units. I think we added about 10 units or so, which adds to additional revenue. So you might be wondering, okay, you threw out a bunch of numbers and a bunch of stuff. So, what would I have to do to put together an investment like this? Well, what we did was we raised $1.75 million from our investors, from our private capital, our syndicated equity, and they participated in the cash flow and the upside of this investment. So how did we spend that $1.75 million? Well, we spent $1.335 on the purchase. We spent $300,000 to fix it up. We put $25,000 into closing costs, title, escrow, insurance, things like that to close the property. Some of that was signage, etc. Then we made sure we had $40,000 for losing money, right? Because we were buying this property and it was losing income initially as we started to lease up the facility. And then we just threw 50 grand in the bank for reserves. This is kind of rainy day funds, making sure we have enough cash in circulation to run the day-to-day business. And so what we did with that cash is we painted the buildings, we fixed up the units, we improved the lighting, we improved the drive aisles. That's a picture of kind of post fix-up. We changed out all the broken locks. There was tons of locks at the property where that little locking arm was just rusted out, burned out, broken, whatever it was. We replaced a lot of doors, a lot of hinges, things. The door springs were busted on a lot of really these taller doors that made it hard to open and close. We made some really nice signage for the road. We painted it. We made sure that the property was well positioned along Boat Club Road to make sure that we could get good customers. And then you can't really see it in this picture, but we actually paved some of the concrete. We did the concrete in the units and really kind of cleaned up each of the units. Call center really drives. It's amazing how much traffic you can get, how much income you can earn, and customers you can retain if you just answer the phone. It's amazing how many times we buy properties where someone's just not picking up when the customer calls and wants to use your property. So making sure you have a well-staffed call center is really important. Ease of booking. Got to go on our website, make it really easy. Pay online, reoccurring payments, reserve a unit, move yourself in. You don't even have to talk to anybody to move yourself into this property. You can show up to the gate. You can get out your smartphone, which is kind of like a kiosk, right? And you can dial in your information, credit card, payment, and you can get a code generated if you pay and sign the lease, and you can get into the property without talking to anybody. So this is a fully automated property now. We offered amenities like free air. And again, now we have, I logged in today, we have 38 or 39 5-star reviews on Google. This is customers raving about the experience that they're getting at our property. And when you look at comparable properties in the area, we have the highest reviews and we have the most, most 5-star reviews, I should say. I don't know if we have the most, but we have the best, highest rated reviews. And so if customers are looking for storage in the area, and they see 39 reviews or so of 5-star, that means they're going to probably trust our property and get an idea that this is a really well-run facility. So what happened? We put this whole plan together. So what actually happened? Well, we ended up kind of doing an inadvertent BRRRR. And I don't know, if you probably have heard people talk about this method, if you can Google it. But basically, BRRRR is buy, renovate, rent, refinance, and repeat or return or whatever you want to say the last one is. But we bought this property for $1.335 million. We paid all cash for it. We didn't want to bother going and getting a loan because the thing wasn't producing income. It would have been difficult, and it was really not that big of a purchase price. Especially, this is probably one of the smallest deals we've ever done. So renovation of the property, clean paint, cameras, drive aisles, that was $300K. We spent that money in cash, and then we started renting the units out. Right, we made it easy to book. And we carried about $40K of lease-up losses while we rented out the facility. And once we had that property 90% occupied, we went to a bank and said, hey, we've owned this property for a couple of years, and it's 90% occupied now. It's producing great income. I think at the time of the refi, we were producing about $168,000 a year of NOI. And they said, yeah, we'll give you a loan. And so we did a refinance of about 4% interest at the time. Nice interest rate today. And they gave us $2.1 million loan. So not only did we recover 100% of the cash, the $1.75 million, but we actually got a $2.1 million loan back. So all of our cash out of the deal, plus an extra $250,000 or $350,000 on top of that, that all came back tax-free. And so what we did with that money is we gave it all back to our investors, and they still own in this opportunity. They still own 100% like they did before the refinance, and they're getting cash flow still because even though we put debt on the property, we still have revenue in excess of our debt service. So really, really awesome opportunity. If you can find properties like this, I highly encourage you looking into maybe doing a BRRRR method or looking to partner with someone to buy an opportunity like this. So I wanted to leave time for questions, but if you want to learn more about self-storage, you can go to our website, spartan-investors.com. Our website's up on the screen. And you can join our newsletter. You can actually join our RSS feed. We put out a magazine every month that we mail to our investors. We publish articles about how to build self-storage, how to buy self-storage, what markets should you be looking in. We've wrote several ebooks now on identifying the best opportunities in self-storage and how to finance and buy them. We also have a lot of information on the construction of self-storage since we do so much of it. But if you want to join in our newsletter, that's a really great information source. And with that, I'm going to wrap things up and open it up for questions.
Awesome. Thank you, Ryan. All right, guys. So go ahead and throw your questions in here. We do have one in there right now. It's from Bob asking, considering ROI for a passive investor, would you compare investing in a self-storage syndication that builds self-storage and sells versus one that buys, holds, improves, and sells eventually?
Oh, I love this question. I almost had enough time to do a comparison between like a ground up development that builds and sells versus kind of a buy and holds or buys and leases up. And I'll just say that it obviously depends on any situation, but there's considerations. If you're buying and building right away at certificate of occupancy, there's some tax implications to that. Obviously, you're probably operating under short-term capital gains, so there might be you might be paying higher taxes. But if you're within an IRA, then you might not that might not apply. But obviously, do your own research on that. But if you enter it into service and you start collecting income, the IRS allows depreciation, and you can take some more long-term tax advantages. And if you sell at C of O or you sell after it's been built, you might be leaving some meat on the bone for somebody else. You typically have to sell that at a discount because the buyer is going to come in and say, this is a great property and everything. I'm sure it's going to lease up great, but I have to discount your property because you need to lease it up still, and that's inherent risk. And I'm going to lose money while I lease up the property. So you might be paying less. You might not be squeezing all the juice out of an investment. But you look at the other side of that, you're taking your risk off the table and you're locking in your gains. So my suggestion is, the way we look at this is because we buy existing properties and we build properties. We offer two funds for the two different types of investing. And when we're looking at buying and building, or buying, building, and selling right away versus holding long term, we ask ourselves, what did the investment expect to get? And are we earning that investment right now? Because if we're going to get that return today, let's sell it, right? So lots kind of a loaded question, but I would say it all boils down to risk and what you can kind of get buying versus selling. So
Awesome. So next question is coming in. So what's the minimum and average investment for a self-storage syndication? And I'm thinking they're talking about for the investor going in.
Yeah, so in our syndications, our minimums are 50,000. Other syndications, their minimums might be 25,000. I've seen as high as $500,000. So, but our syndications are always 50,000 for the minimum.
Good deal. And then Kevin's asking a question saying, do you ever form a relationship with non-accredited investors so that they can invest, or is it just strictly accredited investors?
Absolutely. We do a handful a year. There's most of our syndications are not for accredited investors. For a non-accredited investor, you have to take a couple of steps. You have to get to know us. You have to schedule a call and get on our list, and we have to kind of get to know you, ask you a few questions. You have to fill out a 11-question kind of purchaser qualification form. But once you do that, we do tend to, from time to time, offer non-accredited opportunities.
Awesome. And then, so I guess I got a question for you. Whenever you're doing your due diligence on a property, right? Whether it's to buy an existing property or to just buy land and develop on it, are there any red flags that's just an absolute deal breaker, right? That no matter how good it looks, everything else, if it has this one factor, or this set of factors, that it's a no?
Demand.
Yeah.
So demand is the number one thing. If you're going to build, you've got to make sure you have the demand, because you could be spending our average ground up development's about a $10 million cost. And so if you're going to spend $10 million on building something, you better make damn well sure that at the end of it, you can actually lease it up, because that's a lot of cash to invest when you don't have the demand for your customers. So I would say far and beyond that is number one. The second thing that, very close to that when you're building is, the zoning and entitlements. You got to make sure that you can actually do what you set out to do, to build that. So demand studies are critical. We do them ourselves, but there's third-party services that actually will do a demand study for you and kind of give you a thumbs up, thumbs down. We use all the same tools and resources that they have access to, but you might pay as little as $500 just to give a quick sniff test on something to see, hey, should I even bother, or should I just wave off? And then a full-blown study that usually a bank is going to want to see is between $5,000 and $10,000, depending on the level of detail that the study includes.
Okay. And when you're looking at areas, is it that you want to see a lot of self-storage units there, knowing that they're catering to probably a higher demand, or are you looking for something that's like, okay, there's not too many here, but we see that as an opportunity, right? Like there's a lack of self-storage.
The latter, because there's data that will allow you to benchmark how much demand there is in a given location. Self-storage is a 1 mile or a 3 mile business, meaning that all your customers are going to come from right there, right? You drop that pin, they're not coming from far away, right? They're going to come within that mile. So you can actually see what the utilization rate is for self-storage in your state and the surrounding cities, and you can kind of benchmark how much unmet demand there is. Texas, double-digit square footage utilization. So Texas, a lot of people use self-storage in Texas, believe it or not. It's one of the highest states for consumption of self-storage. Texas doesn't have basements, and the attics are hot, right, and humid, right? So you're really only dealing with that kind of middle area to store stuff. And even though there's a lot of land in Texas, people use a high number of self-storage. So you might go into a market, there might be no self-storage there, so you can build a lot of it because it's not there, right? Now, it is sometimes helpful to have some existing properties, so you can have a really good understanding of rental comps. How much are people charging? How much could I charge? How full are they? You can go over there and mystery shop those competitors and kind of see, okay, hey, guys got any vacant units? And, they might, oh, no, we never have vacant units, or, oh, yeah, we have a lot of vacancy, or whatever it might be. So that might be helpful to understanding the demand. But you really want to be in a market, ideally, I mean, you can have other properties there. It's pretty common. But ideally, you'd want to have less than more.
Okay. And then when you're looking at, what the best areas, I've seen people that they'll say, all right, they'll want to set up a storage unit in which they can allow for like 18-wheeler parking, right, and stuff like that. Is that something that you guys will look into, or do you focus more on just simply like residential, per unit parking, or per unit storage?
Parking never really drives our decision, and here's why. Parking, let's just say a typical RV parking spot is 10 by 50 feet, just to make it, it's usually 12, but let's make math easy. 10 times 50 is 500 square feet to park an RV. That is a big piece of dirt. A self-storage unit, all self-storage needs is a 5 by 5. But for the sake of conversation, let's just say 10 by 10, right? You could have 5 10 by 10s fit within a 10 by 50 parking spot.
Yeah.
And typical parking, $100 a month, $150 a month, right? You're not going to pay much more than $150 for an RV spot. But a 10 by 10, average price for a 10 by 10 is about $90 a month. So 5 times $90 is how much more revenue you could generate with storage. So to answer your question, we would prefer that we build as much self-storage as we can, because our price per square foot is going to be so much more efficient than doing parking. Now, if we've exhausted the demand in a market and we have excess land for RV storage, absolutely. We'll put it out there, and we've got, I don't know, maybe 2,000 or 3,000 RV pads across our portfolio. Makes a lot of sense if you can't build any more traditional self-storage.
Yeah. Okay.
Yeah.
All right, guys. If you have any more questions, throw them in here. Looks like that's it, Ryan. We really do appreciate you for coming out and speaking out. Always enjoy it when you come and present. Guys, if you have questions for Ryan, his email's right up there. Give them a call, shoot him an email. I'd be happy to help. If you have something related to the IRAs, give us a call. We're happy to answer any questions. But until then, Ryan, you have a great weekend.
All right. Thank you. Appreciate it.
Thank you, guys.